What would happen if you invested just $100 online? Not in one place, but across 5 completely different types of investments. 4 years ago, I decided to run a small experiment to find out. I took $100 and split it across 5 popular investments that beginners often hear about: individual stocks, real estate investment trusts, cryptocurrency, gold, and index funds. Today, we're going to look at how each one performed, but more importantly, we're going to compare them based on 5 key factors: how difficult they are to learn, their potential to generate passive income, how tax efficient they can be, their level of risk, and finally, the real return after 4 years. Just to be clear, this video is for educational purposes only. I'm not a financial advisor, and this isn't financial advice. Always do your own research before investing. With that out of the way, let's start with the first investment.
Individual stocks. When you buy an individual stock, you're buying a small ownership stake in a company. If the company grows and becomes more valuable, the value of your investment can increase as well. Many people enjoy stock investing because it allows them to support businesses they believe in. However, choosing individual stocks can require a fair amount of research. Investors often review company financial statements, leadership teams, and long-term business performance before deciding to invest. Because of that, the learning curve here is relatively high. Stocks can generate returns in 2 main ways. The first is price growth. If the stock becomes more valuable over time, you may be able to sell it for more than you paid. The second is dividends. Some companies share a portion of their profits with shareholders through regular payments. From a tax perspective, many countries offer investment accounts that can reduce or eliminate taxes on stock gains, depending on where you live. But risk is something investors need to consider carefully. When you invest in a single company, your investment depends heavily on how that one business performs. If the company struggles, the value of the stock can fall significantly. For my experiment, I decided to make things interesting. Instead of researching a company, I randomly selected one from a list of major companies just to demonstrate how unpredictable stock picking can be. The result? The $100 investment ended up falling to about $67 after 4 years. However, it's important to remember that this is just one example. If the money had been invested in a different company during the same period, the outcome could have been very different. For example, some large technology companies saw significant growth during those same 4 years. This highlights one of the biggest challenges with individual stock investing: choosing the right companies consistently. Next, let's look at real estate investment trusts.
REITs. A REIT, or Real Estate Investment Trust, is a way to invest in property without actually buying a building yourself. Instead of purchasing an entire property, investors pool their money together. The trust then uses that money to buy and manage real estate, such as office buildings, shopping centers, apartments, or hotels. The income generated from renting those properties is then shared with investors. Compared with buying physical real estate, REITs are much easier to get started with. You don't need a mortgage, a large deposit, or to manage tenants. Because of that, the learning curve is moderate. One reason REITs are popular is their passive income potential. Many REITs distribute a large portion of their profits to investors in the form of dividends. In terms of risk, REITs tend to sit somewhere in the middle. They can be more stable than investing in a single company, but they are still influenced by the overall property market. In my experiment, the $100 invested in a REIT was worth slightly less after 4 years. However, when dividend payments were included, the total value ended up slightly higher than the original investment. So even though the price itself didn't grow much, the income helped offset that. Now let's move to one of the most talked about investments in recent years: cryptocurrency.
Cryptocurrency. Cryptocurrency is a form of digital money that operates on blockchain technology. Unlike traditional currencies, most cryptocurrencies are not controlled by a central bank or government. Instead, transactions are verified by networks of computers around the world. Assets like Bitcoin and Ethereum have attracted a lot of attention over the past decade because of their dramatic price movements. Some investors have seen substantial gains, while others have experienced significant losses. Because of that, many people consider cryptocurrency a higher risk investment. Learning how crypto works usually involves understanding wallets, exchanges, and how blockchain networks operate. That makes the learning curve moderate. Unlike stocks or property investments, most cryptocurrencies don't produce income by default. However, some investors earn rewards through activities like staking or lending their crypto. For my experiment, I invested $100 into Bitcoin and left it untouched for 4 years. By the time I checked the result, the value had grown to over $650. That's a huge increase, but it's important to remember that cryptocurrency prices can also fall dramatically. High potential returns often come with high volatility. Next, let's talk about gold.
Gold has been used as a store of value for thousands of years. Many investors see it as a way to protect wealth during periods of economic uncertainty or high inflation. One advantage of gold is its simplicity. You can buy physical gold in the form of coins or bars, or you can invest through funds that track the price of gold. Because of that, the learning curve is relatively low. However, gold doesn't produce income like stocks or property. Its value comes entirely from price changes over time. In my experiment, the $100 invested in gold grew to roughly $140 over 4 years. That kind of growth isn't as dramatic as some other investments, but gold has historically been valued for stability rather than rapid growth. Finally, let's look at index funds.
Index funds. An index fund is designed to track the performance of a group of companies rather than a single one. For example, some index funds follow the performance of the largest companies in a stock market index. Instead of choosing individual stocks, investors buy one fund that already contains hundreds of companies. This diversification reduces the impact of any single company performing poorly. Because of that, the learning curve is quite low. Many investors simply invest regularly and hold index funds for long periods of time. Index funds can also provide some passive income through dividends paid by the companies within the fund. Historically, broad market indexes have produced steady long-term growth, although returns can vary depending on the time period. In my experiment, the $100 invested in an index fund grew to around $179 over 4 years. That makes it one of the stronger performers in this comparison.
So, what did this small experiment show? Every investment we looked at had different strengths and weaknesses. Some offered higher potential growth but came with greater volatility. Others were more stable but grew more slowly. The biggest takeaway is that investing is rarely about finding a single perfect asset. Instead, many investors spread their money across different investments to balance growth, stability, and risk. And perhaps the most important factor of all is time. Even relatively small investments can grow significantly if they are given enough time to compound. If you're interested in learning more about how compounding works and why it plays such a powerful role in investing, you can check out the next video here. Thanks for watching.